Hi, good morning, everyone. Thanks for joining us for our weekly Monday morning call. Today's agenda will include Koda Limited initiation, Frasers Centrepoint Trust, CapitaLand, Dasin, Suntec REIT, and SGX, followed by Singapore Weekly. Do note that our webinar for next Monday, 2nd of August, will begin at 11:30 a.m. instead of the usual 11:15 a.m. So without further ado, I'll pass my time on to Vivian for Koda Limited.
Thank you, Timothy, and good morning, everyone. So for Koda, our title of the report is Furniture Boom in the US as we see higher export sales to the US, which I'll be also explaining more on later on. To start off with a brief company background, Koda was listed on the then Nasdaq board, which is now called Catalyst, in January 2002 and migrated to the SGX main board since May 2005. They are a leading original design manufacturer, or ODM, of various types of home furniture. A short history: the company was founded in 1972 as a small workshop producing wooden cabinets, and they have since expanded to producing wood-based home furniture for the living, dining, and bedroom, as you can see from the pictures on your right. In our next slide, we'll be looking at the business segments that they have. So on your left, you can see that they have manufacturing, under which they are the ODM, meaning that the furniture is designed and made by them according to the customer's specifications, then rebranded by overseas customers for sale. The overseas customers here could also refer to the well-known US brands that you can see on Orchard Road. Under this segment, they export furniture to 30 countries in North America, Asia Pacific, and Europe, and also other countries. And North America alone contributed 55.3% to FY20 revenue. The picture on the bottom left is an example of their manufacturing facility in Vietnam, and they have another one in Malaysia. So referring to the picture, the segment on your right, which is their retail and distribution segment, under which they operate the Commune retail brand. Commune was established in 2011 with the first store in Singapore, and after which they opened the first overseas store in China in 2014. Currently, they have 85 Commune outlets in 4 countries, including China, Malaysia, Singapore, the Philippines, and also Hong Kong. The Commune retail outlets are operated through a dealership such that they will supply the dealers with the products at the wholesale prices, intellectual property, technological capabilities, and also training for the staff. And this also means that they will pass on the responsibility to the dealers to finish selling off the products once they sell the products to the dealers at wholesale prices. Under this segment, they also operate a sister brand, Alto, which was created to sell higher end furniture. So the Commune itself serves more of the middle range, while Alto is more of the higher end furniture. And Alto has 10 stores in Singapore and China. Next, we will be looking at their revenue segmentation. So first of all, manufacturing is their bread and butter and contributed to 82% of FY20 revenue. If you look at the graph on your bottom left, you can see that the contribution from manufacturing, as represented by the dark blue bars, have been quite stable throughout the past 5 financial years at about 80% on average. FY20 revenue increase was driven by higher export sales to North America. So if you refer to the graph on your right, you can see that the contribution from North America, as represented by the dark red bars, have been expanding steadily over the past few financial years. In our next slide, we're moving on to the investment merits. So first of all, first half FY21 PATMI exceeded that of FY20, and we are expecting FY21E PATMI to almost double. In the picture in the graph on your top right, this is the PATMI for the past 5 financial years, as represented by the dark blue bars, and the lighter blue one is the PATMI for first half of FY21, which is already higher than that achieved for FY20. First half FY21 revenue rose as export sales to North America recovered, and we also expect this to support the increase in PATMI for FY21E. And year to May 2021, US furniture imports rose 44% year on year to $25 billion. And this is also even higher than pre-COVID levels in 2019 of about 18%. So if you refer to the graph on your bottom right, this is the value of US furniture imports represented by the dark blue bars. You can see that it fell around the period around April 2020 and has increased sharply ever since and is higher than pre-COVID levels. So most recently, the most recent data in May 2021, it represented a more than 100% year-on-year increase. Another factor is the US-China trade war, as a result of which Vietnam became the world's largest furniture exporter. In 2020, Vietnam exported $7.4 billion worth of furniture to the US, which is up 31% year-on-year. Even though this is only slightly higher than the 7.3 billion from China, it shows the increasingly important position of Vietnam in the global furniture export market. In the next slide, we'll be looking at the second investment merit, which is the expansion of production capacity in Vietnam. So in March 2021, Koda announced the acquisition of a land and factory building, which is to increase capacity for mixed material furniture production, storage, and warehousing. And the rationale for this is that they see increasing or encouraging growth in export orders. So the expansion of the production capacity is necessary to meet the delivery lead time. As you may or may not know, the manufacturing facilities in Vietnam and also Malaysia have been temporarily closed, and the one in Vietnam is comparatively larger. So they have submitted all the relevant documents to the authorities to grant the resumption of their operations, and they could resume as long as all workers stay within this confined area in the manufacturing facility. So Koda has to provide lodging, meals, and so on. And this is the same for all other furniture manufacturers in Vietnam. Apart from that, another interesting point to note would be Koda has ventured into the manufacturing of sofa. And among various types of furniture, sofa actually has the most straightforward manufacturing process, as it doesn't really require any craftsmanship, and it's basically just piecing together the various raw materials. So moving on to the last investment merit, they also have an additional source of growth, which is the commune retail outlets. We are expecting 100 retail stores in China by the end of 2022, and there are currently 75 retail stores in China. The revenue from this segment grew at a CAGR of 13.2% over the past 5 financial years, and we see that the increase in retail stores will continue to support the revenue growth. Year to June 2021, furniture retail sales in China grew about 20% year-on-year as due to the recovery in retail spending, as the life in China mostly returned to normalcy. So you could also refer to the pictures on the right. The top is an example of the commune outlet in Chongqing. And the pictures on the bottom left and right show you the fact that commune has been using technology to enhance the customer's shopping experience. So through virtual reality, you could visualize how the furniture would fit into your houses. And on the right is an example of AR, which is augmented reality. This is, you can try it directly on their website at thecommunelife.com. No advertising intended. Yeah, but anyway, if you click on a certain product and take a short video of your surroundings, you could see how, for example, this chair would fit into your surrounding. Yeah, lastly, moving on, will be the valuation. So we initiate coverage on Koda with a buy rating and a target price of $1.32. This target price is set at 7 times FY21 ex cash PE, slightly higher than the historical average ex cash PE of 4 times, as you can see from the graph, as we believe that there is room for valuation expansion if Koda is able to sustain the earnings growth. And stock catalysts are expected from higher exports to the US and also increase in production capacity. So that's all for me for Koda, and I will now be passing the time on to Natalie for Frasers Centrepoint Trust.
Thank you, Vivian, and good morning, everyone. So we'll start off with Frasers Centrepoint Trust third quarter 21 business update. Starting off with the positives, retail occupancy inched up 0.3 percentage points quarter on quarter and 1.8 percentage points year on year to 96.4%. So at this level, occupancy has normaled to pre-pandemic levels. And across the portfolio, occupancy shifted by negative 4.8 percentage points to 7.3 percentage points across its 10 assets due to tenant churns and lumpy expiries at Century Square. The second positive would be the 11.8% of NLA signed in the third quarter of 2021. So FCT is on track in renewals, de-risking 80% of its leases expiring in FY21. Only 8.2% of leases remain, half of which are with mini anchor tenants and are in advanced stages of negotiation. So the 20,000 square feet of space vacated by H&M at Waterway Point in the second quarter of 2021 has been 75% backfilled, and this will be leased to 9 tenants, commanding positive rental reversions in aggregate. So FCT has also been refreshing its retail offering. Some of the new tenants added year to date include Donna Donkey, Graham Cafe, Taichung Bakery, Playdress, At Tea, Dasin, and Sui Chun Dim Sum Restaurant. Yeah, so this refreshed offering could potentially help pull in more crowds for its various malls and help to spur tenant sales for its surrounding retailers. On to the negative side, tenant sales fell by 6 to 19% below pre-COVID levels due to the phase 2 heightened alert. You can see this in the graph on the bottom left-hand side of the page. The red line shows the tenant sales for FY21, and in the months of April, May, and June, you see that they are at 94, 88, and 81% of pre-pandemic levels. Okay. However, there is a silver lining. FCT's top 5 trade categories of F&B, beauty and health, fashion, services, and supermarkets contributed 75% to its tenant sales. And these tenants, the decline in tenant sales was more muted in the negative single digits. So recall that FCT also has 45% of its tenants in essential services, and these tenant trades were relatively more resilient. So the likes of your supermarket was expected to perform better, and as well as some tenants that were better able to capture the takeaway sales, etc. So as such, FCT does not expect to provide rental rebates for this group of 45% of tenants in the essential services trade. Okay. Now moving on to outlook. So overall, tenants are still cautious. Overall, tenants are still cautious. And even though FCT has signed some flexible leases with tenants who are struggling and want short-term extensions on variable terms, 95% of the permanent leases, that means leases that are of 3 years duration, have been signed on the traditional base plus structure. So what this is the regular base rent plus a percentage of GTO rent. Yeah. And so actually what this indicates to us is that retailers' confidence in sustaining and improving tenant sales remain high. As such, they have opted out of risk sharing of profits. So moving forward, another thing that will help FCT return to positive rental reversions is the sustained opening visibility, which will support leasing as well as rental growth. So as the economy reopens and tenants can see that the pandemic is under control with less risk of returning to lockdown situations or tightened measures, I think that will help to improve the confidence of the retailers in terms of trading and also committing to leases. So we maintain our buy. Our target price lowered slightly from $2.88 to $2.87. FY21 DPU dips by 7.5% after accounting for 25,000 in rental rebates. So this is equivalent to about 0.35 months of rebate for 55% of its retail tenants over the May to August period. Now moving on to CapitaLand. Okay, for CapitaLand, just last week, they actually released the independent financial advisor valuation, as well as the introductory documents for the listing of CapitaLand Investment, CLI for short. So just as a reminder, this is what the table on the left-hand side. The table on the left-hand side actually shows us what is the implied valuation per share of CapitaLand unit. Okay, so just as a reminder, one CapitaLand share is entitled to one CLI share, 0.155 units of CICT shares, as well as cash consideration of 95 cents. Okay, so based on this table actually provides a range for the independent financial advisors valuation versus the purchase consideration. So before we get to that, for the IFA valuation, it has been conducted using the SOTP, sum of the parts valuation method, and the IFA has broken CLI down into 5 business segments. So they are investment management, which is valued on a PE basis; lodging management, which is valued on a EV over EBITDA metric; investment properties valued at RNAV; unlisted funds valued at carrying value, as well as the listed funds, which comprises the business trust and the REITs, which are valued at market value. Okay, so based on these 5 business segments, the IFA has come up with a valuation range of $3.19 to $3.62. Okay, so if you add up the remaining components of the consideration, the CICT units as well as the cash consideration, that will give us the implied consideration excluding dividends of $4.47 to $4.90 on the IFA side. And this compares to the purchase consideration of $4.10 that has been offered to unit holders. If you add in the FY20 DPU, the FY20 dividends of 9 cents, that brings the implied consideration to $4.56 to $4.99 versus $4.19 from the purchase consideration plus FY20 dividends. Okay, so what you can add, what we understand from this, or what we take away from this, is that the implied consideration of $4.10 is a 27. Sorry, if you look at the graph on the bottom of the page, okay, so the red line here actually shows us the purchase consideration of $4.10 versus the VWAP 12 months, 6 months, 3 months, 1 month VWAP on the left hand side, as well as the share price after the announcement was made. And of course, compared to our PSR's target price and as well as the IFA's valuation. Okay, so you can see that the red line lies above the VWAP and it's at a 38, 35, 26, and 27% premium to the 12 month, 6 month, 3 month, and 1 month VWAP. Okay, and this line and this $4.10 is also a 8 to 18% discount to the IFA's valuation range, which suggests to us that there's still some upside for CLI. So now, next slide. Okay. So in terms of outlook, for the fund management and lodging segments, we believe that they will be better appreciated under CapitaLand's asset-light, capital-efficient business model. In terms of growth drivers, for the fund management business, the growth driver would be the funds under management. Okay, so currently there are $78 billion worth of funds under management, and the target to grow it to $100 billion by 2024 will help to drive revenue for this segment. Not to mention, on CLI's balance sheet, there are some $10 billion in in investment property that will be monetized over the next 3 to 4 years. So the idea of holding this IP is so that they can convert it into funds under management, either by selling it to any of their private funds or their REITs and business trusts, or at the worst case scenario, they will sell it to a third party. Of course, if the price is right and if they're able to unlock some kind of capital gains from the asset. Another segment would be the lodging segment. So what is driving the value driver for this segment would be the number of keys under management. Presently, they have signed 123,000 keys. 43 of them are still under development and have not yet begun contributing to the revenue. So what this means is that there is still some potential from the keys pipeline that have yet to be unlocked. So apart from this, 43% of keys still under development, the lodging segment is expected, or rather the target for the lodging segment would be 160,000 keys by 2023. Yeah, so these two segments will be the ones that are channeling spearheading the revenue growth. Okay. Overall, we maintain our buy call on CapitaLand. We leave our target price unchanged at $4.38, and our target price is based on a 80% probability weighted RNAV that the merger will be approved. Okay. So just to reiterate the merits we see of this merger, we think that the immediate upside from the development business at 0.5 times book value offered is a clear advantage compared to where CapitaLand has been trading in the past, which is at a 20 to 30% discount to NAV. Okay, so that's all for CapitaLand. I'll move on to Dasin. Okay, so for Dasin, just want to provide a quick update on the various on the events that have happened year to date. So starting off with at the start of the year, okay, so Dasin entered FY21 with 516 million of loans on its current liabilities. So that represents 55% of total borrowings that will have to be refinanced within the next 12 months. So this led to a negative working capital of $406 million. In January, this is when bulk of the loans would have expired. They were unable to secure refinancing. Instead, they managed to get a 6-month extension on the loan facility. So this brought the extension to 20 July 2021. On the 14th of April, the auditor, they shared with us the auditor's opinion, which was an unqualified opinion with an emphasis on matter on the ability to refinance the loan, which might actually lead to insolvency. Okay. On just 1 week after that, 21st of April, the chairman, Mr. Chang, actually entered into a non-binding MOU with a strategic partner, ARA Asset Management. So under this partnership deal with ARA, the chairman, Mr. Chang, will sell a 50% stake of the trustee manager to ARA, as well as a 5% of the units in Dasin from his own stockpile, where he has where he's managing this fund called Aqua Wealth that holds 53% of the units in Dasin. Okay, so 1 week later, they managed to give a response to the SGX query on the ability to continue as a going concern due to the negative working capital. So just to summarize what was said in that SGX reply, it was basically saying that they do not see any issue with the loan refinancing and that they are still cash positive, as in their operations are still cash positive. Just a day after, they managed to ink the sales and purchase agreement with ARA. However, on the 5th of July, this SMP with ARA was terminated, and Mr. Chang actually entered into a non-binding MOU with Sino-Ocean Capital. Okay, so this agreement with Sino-Ocean Capital tentatively was for Mr. Chang to sell 70% of the stake in the trustee manager, as well as issue a sale of units so as to increase Sino-Ocean's current shareholding from 6.36% up to 26%. So just to be clear, Sino-Ocean is already a shareholder of Dasin and has been since 2019 with a 6.36% stake. Okay. And just a little bit of background on Sino-Ocean. So Sino-Ocean is actually one of the top 100 property groups in China, and it is backed by two insurance heavyweights, China Life Insurance Company, which is listed on the Hong Kong and China Stock Exchange, as well as Dajia Life Insurance Company, which is not listed. So both of these insurance companies hold a 29.59% stake in the group. Yeah. And Sino-Ocean Group's core business is residential property development, investment property development, operations of property services, as well as real estate financing, senior life services, and logistic properties. Yeah. So they do have real estate capabilities. So one of the potential benefits of this partnership with Sino-Ocean could be possible synergies in real estate management. Okay. So this non-binding MOU was eventually signed 5 days later, converting it into a binding MOU, sales and purchase agreement. Okay, that was and last of all, the most recent update was the extension of loan facilities. So as of 20th July, the loan facilities have been extended for another 5 months. Yeah, up to 19 December 2021. So what do we think? The extension of 516 million in loan repayment to 19 December is a small reprieve. However, we still expect, the market still needs to see the refinancing of loan before it becomes more confident of Dasin. Loan financing may have been hampered by the potential change in the trustee manager ownership, which would have likely warranted a reset of the Dasin's credit review process. Hence, that could be one of the source of delays in terms of loan refinancing. So the sale and purchase agreement between Mr. Chang and Sino-Ocean entity New Harvest, just to reiterate, Sino-Ocean will be buying a 70% stake in a trustee manager, as well as be issued a call option to increase its stake from 6.36% to 26%. So that will make it a more substantial. That will give it a more substantial stake in Dasin. And Sino-Ocean could potentially support Dasin by extending intercompany loans or even extension of a ROFR pipeline. Okay, so overall, we maintain our accumulate target price lowered from 82 cents to 78 cents. And this is because we account for higher cost of borrowing. So with FY21 and FY22 DPUs were cut by 14.8% and 5.7% due to higher borrowing costs. And the current price implies a yield of 7.4% and 8.2% for FY21 and FY22. So one of the risks that we would like to point out is that the borrowings are actually secured against its properties. So which means to say that in the event where Dasin cannot refinance or extend its loans, the bank can actually seize the assets and liquidate them to get back their loans. Yeah, so this is just one of the things that we would like to highlight as a risk. Okay, so that's all for me. I'll now pass the time on to Jie Hui for Suntec REIT.
Thanks, Ned. Yeah, next we have our Phillip on the ground on Suntec REIT's first half results. Just a note, we do not cover the counter. Okay, so looking at the first point of the key highlights, you can tell that Suntec REIT is performing better this half as compared to a year ago. This is mainly due to increased contributions from the properties that are newly acquired, lesser rent assistance at Suntec City Mall, as well as one-off compensation received from ORQ and MBFC. Now breaking down into segments, office is still the biggest anchor at 84% to Suntec's income stream. Singapore's offices saw more renewals than new leases, with most of the new tenants coming from the tech, media and telecom, as well as financial institutions and real estate industries. With higher office occupancy, minimal FY21 expiries and limited supply coming up, office is likely to be stable for now. It is likely that Suntec REIT will end the year with positive rent reversions. That said, there may be greater rent pressures next year when Guoku Midtown, located next door from Suntec, start to ramp up their pre-commitment levels. It is currently now at 9%. Stanchart is also giving up 200,000 square feet of space from 4Q next year, which is why there's a one-off compensation from MBFC. For the UBS space at ORQ, 96% of it has been backfilled. the Australia and UK portfolio still remains resilient with minimal expiries of 1% for the year and high office occupancies. This is with the exception of 21 Harry Street, which is still on rent guarantee for vacant spaces. Now on the retail side of the business, retail is still suffering. If you can look at the chart on your right, mall traffic and tenant sales is still 20 to 40% below 2019 levels. As such, Suntec REIT is providing rent restructuring for 40% of its leases, and this will likely extend till the end of the quarter. Base rents are expected to drop by 25% for those leases, and the rents will factor in a higher gross turnover component. Rent rebates of up to half a month for 95% of the tenants are also expected to be provided, and up to a quarter to be provided for those businesses that were closed during the period. Tenants eligible for the rent rebates excludes trades like banks and supermarkets, which were more resilient during the period. In terms of retail leasing environment, it still remains weak, although quarter on quarter it showed improvements. To maintain higher retail occupancy of 94%, rent reversions are negative 15% for first half 21. This will likely stay the same moving forward. Now for the last portion, the convention segment is still making losses. If you can look at the chart above, Suntec REIT is seeing a pickup in activities from weddings and church events. However, given the recent extension of phase 2 heightened alert, leasing demand may still see a stunted recovery in the coming quarter. This is all for Suntec REIT's Phillip on the ground. I'll pass my time on to Terence for SGX.
Yeah, thanks, Jie Hui, and good morning, everyone. The title of our latest report on Singapore Exchange is Another Step Toward a Multi-Asset Exchange. This is in reference to their latest acquisition of MaxxTrader. In our next slide, SGX has announced the acquisition of MaxxTrader from Flex Trade Systems, a global leader in multi-asset execution and order management systems, for a cash consideration of approximately $125 million. SGX expects the closure of the deal by December 2021. For us, we see three main positives from the acquisition of MaxxTrader. Firstly, the acquisition of MaxxTrader will further scale up Forex as a core pillar of growth for the group. This will broaden its Forex offerings and access to institutional clients. In summary, what it does is to leverage MaxxTrader's technology to offer clients a full suite of Forex, futures, and OTC solutions. So such a platform would accelerate its ability to provide fungible and convenient access to global customers to different pools of liquidity, all under one integrated platform on SGX. In summary, I know it's a little bit long, but in summary, what this means is that they are able to provide a full suite of access for their client, the buy and sell side clients to trade Forex. The second positive we see from the acquisition of MaxxTrader is that it is going to be earnings accretive with performance-based earnouts. So the acquisition of MaxxTrader will be earnings accretive for SGX from day one. And more importantly for us, the acquisition will come with performance-based earnouts to incentivize the current management of MaxxTrader to achieve the revenue targets that have been set out. So we think that this alignment of interest between management and the SGX group will be positive for the group in terms of meeting the financial objectives. The whole entire acquisition values MaxxTrader at 8.3 times current year 2020 sales. Lastly, revenue growth is expected to accelerate from its historical 14 to 15% CAGR in the last 5 years to slightly higher, to about mid-teens level in the next few years. In the next slide in our outlook, the latest deal follows SGX acquisition of cloud-based Forex trading platform BitFX last year. The two purchases combined have paved the way for the BOS to become Asia's largest one-stop venue for international Forex, OTC, and futures participants. The BOS has committed to acquiring different asset classes to improve end-to-end efficiency for clients. For our investment recommendation, we raised our target price to $11.95 from $11.25 previously. We now peg the valuation of SGX to +2 standard deviation of its 5-year mean, or 25 times PE, up from the 23 times its mean previously. So the reason why we upgraded from the our valuation from the mean to +2 standard deviation now is to capture the faster growth trajectory of SGX compared to the growth in the last 5 years. Nevertheless, we downgrade to neutral from accumulate as we believe most of the positives have been priced in. That's all from me. I'll now hand over the time to Paul to cover the Singapore Weekly.
Thanks, Terence. Next slide, please. Okay, I'll just run through some of the key macro highlights for Singapore that were released last week. We had the core CPI number. I think a lot of media away, but actually there's really no impact on the market at all. So long as it's within the MAS target of 0 to 1%. There was also news on HDB prices. The second quarter HDB prices were up about 3%. And actually over the running 12 months is actually up a very strong 11%. But if you take a longer term perspective from 2013, I think HDB prices are basically flat over the last 8 years. And so after 8 years, the HDB prices basically didn't move at all. If you just look at the index. But the volumes were strong. So resale volumes were up 100% year on year on the second quarter. So this should pave way for some good numbers coming up from the property agents. As you know, they are reliant on volumes. The next part would be private residential prices. It was slower, which in fact could be good news. I mean, that kind of reduces the risk of cooling measures. As highlighted before, what we monitor is the running 12 months increase in private residential prices. 10% seems to be a number that worries some of the real estate agents, because 10% over 1 year means 5 years could be even 50%. So, but right now over the last 12 months is up about 7%. And if you take a longer term stance, again, over the past 8 years, the property prices are only up about 6%. So, I mean, it's less than 1% a year. So hopefully the authorities take all this into consideration. In terms of the US, I guess we'll be looking forward towards the FOMC meeting coming up this week. But we think they will still be very dovish, unlikely to change much in terms of their view, because it's still unclear if inflation is temporary and they will unlikely to preempt. So what we mean is that they've always said that unless they see inflation running even faster, which is likely to be, they're looking at probably at the September, October numbers, because there's a lot of base effect right now. Only then will they try to move the numbers. I mean, that's our view. And also, in the background, we still have the pandemic rebounding in US, and also vaccinations are kind of stalling in the US. Later on, I'll just discuss quickly on the SPH third quarter update for those who were not able to attend. Technically, we're still positive on the market. I think we're going to expect some very strong numbers, especially from the base effect last year. So we expect a lot of the croppers to be, US they are already, but in the Singapore, we also expect some strong numbers, because a year ago, our second quarter was obviously very, very poor. So you're going to have this big surge in a lot of the results coming out. So that should kind of help sentiment in the market. And the next point is of the low interest rate environment. We expect it to persist. In terms of the kind of big events, I think for this week, you're going to have ultimately most of the FANG stocks will be announcing results. I think you can see from yourselves in Apple, Facebook, Amazon, all these guys will be releasing numbers just for your reference. For Pullman's webinar, we actually have one later at 1 p.m. So maybe might have to end it earlier at 12:30 later today. Then the following on Wednesday, when we will have Wednesday, we have CapitaLand and Southern Alliance. Some new additions we have will be MegaCam and also Halcyon. So if you feel free to register, it's open to everyone in our Pullman's website. Thank you. Next slide. We'll move on to the resurgence in cases. So if you eyeball the blue line, which is the world cases, you can see there's a big bounce, and it's actually rebounding now, bouncing back almost 40% month on month. An interesting thing is happening in the UK. I know UK is the first to kind of like full-blown open their borders, no masks, no safe distancing. So I guess the whole world will be monitoring. I guess one interesting event that happened is there's this thing called the pingdemic. So what happened is that those who are close distance will get pinged by the NHS, which is their MOH equivalent. As a result, there were a lot of shortages of workers. I think 600,000 people got pinged and they couldn't go to work for 10 days. So that caused a lot of disruption. So I guess it's just an interesting thing to watch, because eventually Singapore is going to do this aggressive reopening. Next slide. I won't run through this. I think we all know in the region, Indonesia, the cases are surging. Likewise, Malaysia, the yellow line, and Thailand too. we also get this big wave in the UK as they are opening up. Next slide. Okay, in Singapore, the numbers is not good. I think if you look at the number of cases, the red line, I think we are now triple the number of cases per day, average cases per day, compared to circuit breaker. So during circuit breaker, the cases were roughly about 50, and now we are running in Singapore about 150. So we are triple the number. So we got like 1,000 cases compared to a week ago. But the good news, if there's any, is that there's only one person in the ICU compared to our capacity of 1,000. And for first doses, we already reached about 74%. So it's the good number to have is ideally will be like 80%. Then we know we can have this. I mean, depending on your definitions, the so-called herd immunity. Next slide. Okay, this is just a graphical illustration of the property price. You can see that the property for HDB, even though it's bounced up 11%, the blue line, you can see that we are still below the peak in second quarter 1.3 roughly. We're still low. So even after 8 years, we are still flat if you want to do a point-to-point kind of comparison. But the bar chart, you can see the volumes are very strong compared to 2020. So you're going to get some good numbers for the real estate agents. This is just a chart on the private property price. Yeah, we are reaching new highs, but again, compared to, we kind of avoided the 10% rise over 12 months, which a lot of people are a bit worried that if over 12 months you rise, then the authorities might kind of like annualize it, then you got 50% over 5 years and start to put in cooling measures. So hopefully this could be taken into account. Over 12 months, we're only up about 7. Next. Okay, we just wanted to do this because we saw a lot of questions about the volatility, because on Monday there was a bit of sell down. So just a reminder that for the US market, we just do a check that every 2 weeks you will get a 1% drop. Every month you should get at least a 1.5%, a huge 1.5% drop. So volatility is a norm. I mean, just wanted to show you nothing much about this, but you can see that from this table, the one you highlighted in red, over the last 5 years, the S&P index has doubled, but in between then you always get this 1% drop every 2 weeks, or even more than 1.5% drop every month. So just get used to it. I mean, it doesn't derail. You can see that the US still gets it's still doubled over the 5 years. The most volatile period, if you want to check, is the 2020, where you got like big 1.5 drops 13% of the trading days. Yeah. So that means every 2 weeks you get 1.5% kind of drop. More than 1.5%. Okay, next slide. That is just for your reference. Okay, we also attended the third quarter briefing by SPH. So right now, SPH, just to recap, has media, PBSA. PBSA is basically student dorms. That means in the UK. So if a student wants to stay near the uni, they just can rent their dorms. Aged care, and also retail, and of course digital assets. So from the briefing, what was mentioned was that the PBSA, which is student dorm, is doing well. They're probably going to be, the premises are going to be full. So the surprise was this, initially the expectations was EU students will be weak because of the Brexit. So I think they won't get those student subsidies. So that happened. EU students were down, but the surprise was China students. So China students rebounded very strongly. They are returning to UK. It seems to be that they are skipping US, and there's also pent-up demand. Pent-up demand means in China, many come to UK for postgraduate, so they can actually maybe delay 1 year, but they still return to UK. And also PBSA, there is room if they've already highlighted before that they could do some capital exercise, some IPO potential, like if it's feasible. Media was weak. Just to go to the fourth bullet point, media remains, the revenue was down. There was no profit numbers given, but they just mentioned that revenue was down. But surprisingly, third quarter is actually up 2%. Another thing they mentioned was the newsprint costs is also rising. So the EGM on disposing the media will be in August, September, and they hope to complete the disposal by end of this year. Okay, there are other things we just wanted to highlight, that there are some hidden assets in SPH. So SG Karma is one. Again, we do not know the valuations, they never mention, or the cost, but the way a lot of these startups are, the valuation, so there could be some hidden surprise there. They also have, I think, 3 good class bungalows, which we did a rough valuation depending how much you want to pay per square foot, you get like 150 million. And I think these good class bungalows are valued at cost. They also have data centers. Some possible share price drivers, we don't cover the stock, but this is just our own view, will be, maybe if they do list the dorms, M1 is disposing some of their towers, so they could kind of farm up some capital back to SPH, which they could actually return it to shareholders. The disposal of Kupang, which is 100+ million gain, and also this 2% stake in Carousel. The table on right is just to show you the decline of media operating revenue. Next slide. Okay, this is our final slide. This is just to remind everyone some of the results coming out. So Keppel DC REIT, those highlighted in yellow are those that we cover. I missed out Keppel DC REIT. So Raffles Medical just released. I was in a call just now, so I had no time to so I'm there. It's still running now, so I missed that part. Okay, this is just for everyone's reference. I guess the largest company here is probably going to be SIA and Keppel Corp's results. Okay, I think that's my last slide. I think we can move on to questions. Thank you, everyone. Oh, yeah, and also as a reminder, for next week, the event, our 11:15 will start at 11:30 due to some scheduling conflict. So we will have to start it next week at 11:30. Sorry for the inconvenience for anyone. Thank you.
I think I'll take the first question that is ranked highest on the Q&A chat, and there are a few companies that the participants listed out. So I'll probably just answer the one relevant to me. Then my other colleagues can weigh in. First question is, hi, can you please share on the situation for the depressing prices for Wilmar, Keppel, and CDL? Should we continue to hold on? So I cover Keppel. For Keppel, there are currently 2 corporate actions covering Keppel at the moment. The first is the MOU that they signed with Sembcorp Marine. So the Keppel is currently exploring a merger with Sembcorp Marine. The merger announcement is expected somewhere around 4th quarter of 2021. And the second MOU that Keppel has signed is with Kyanite Investment Holdings, which is a fully owned subsidiary of Temasek Group. So in summary, just for those who may have missed the announcement, just need to recall, the second MOU that Keppel signed with Kyanite Investment Holdings is to farm out some of the receivables that they currently hold to an external group of investors to hold about 80% of the entity. So in summary, after the conclusion of the 2 non-binding MOUs, Keppel Corporation would be almost rid of the entire O&M business. So we think the current depressed share price for Keppel is the result of uncertainty over the conclusion of whether the deal will be completed, because there is no certainty at this moment as to whether the deal will be completed and the manner in which the distribution will be done. If the merger takes place, in the manner in which the distribution will be done, should the deal take place. So because of a couple of uncertainties, and also don't forget, like what we mentioned is a non-binding MOU. So we think the Keppel share price could continue to remain depressed in the near term, barring any new news, until there's more certainty on this announcement. I'll just take the next question also. Is Sembcorp Marine worth buying at this stage? So for us, we don't have a coverage of Sembcorp Marine, but we follow Sembcorp Marine also in the industry. But we can offer some views. For Sembcorp Marine, I think for us, the main issue with Sembcorp Marine is that the outlook for Sembcorp Marine is the recovery for Sembcorp Marine will remain protracted in the near to mid term. So investors who are looking to buy Sembcorp Marine at this stage will need to take a longer term view before and it won't be a short term play. I think that's what we're trying to say. And try to hope that hope for the recovery once the market improves. Another thing that investors will need to take note of when they buy Sembcorp Marine now is that when you buy Sembcorp Marine now, then you will have to subscribe for the rights once they pass the EGM. So that should be part of the consideration as well. Let me know if I answer your question. I just continue to scroll down to see if there's any questions for me. Yeah, I think that's all for me. I'll hand over to my colleagues.
Okay, can someone? Okay, let me just do quickly the Singtel question. Okay, someone asked whether the Tesla. So sorry for the confusion, but Tesla refers to the results going to be released. OTS is the webinar later, so there is no Tesla webinar. It's just to inform everyone that there is the results for Tesla will be released today. Yeah, so sorry for if there's any confusion by anyone. There's a question on Singtel. Let me just read it out. Do you think Singtel will have an upside potential also considering the dividend yield? We are still neutral, but I think if you want dividend yield, preferably to look at other stocks, maybe the REITs or other, even the banks. Always remember one thing, for the telcos, it's not just a temporary challenge. I think if the borders reopen and roaming comes back, better to buy StarHub. But for all the telcos, the big challenge is where is going to be the growth. When we had sorry, this is going to be a long answer, but when we had 3G, the telcos commanded everything. They commanded international dialing, they commanded SMS. No one could talk to each other unless you have it through the telcos. The telcos virtually had some form of monopoly. But right now, when WhatsApp came out, when all the apps came out, the telcos just lost everything. You want to do international call, you don't need to use a telco, you can do it yourself. So there's a structural change for the whole telco industry, and even for 5G, so far we highly doubt that things will change even with 5G. It will just be another commoditized service. So my own view is that if you want dividend yield, maybe just go to the banks or even the REITs. Okay, I'll hand it over to the rest. Thanks.
Hello, everyone. Maybe I will answer the question on Koda, which came in quite early just now. So for Koda, two questions. What is the risk on the uncertain Delta impact to US, Vietnam, and Malaysia? And the second question is, what is the valuation and TP and positioning of Koda compared to its competitors? So I'll take on the first question first. The risk of the Delta variant to US, Vietnam, and Malaysia. Firstly, for US, don't think there's any negative impact, because if you recall the graph shown earlier, the changes in US furniture imports from pre-COVID levels to most recently May 2021, or you could refer to the report posted on Stocks BNB. It dipped in May 2020 when the world was making sense of what is this COVID, and has since risen. So I think in December or end of 2020, the COVID situation was the most serious in the US, but the US furniture imports actually rose back then rose to pre-COVID. So with the surge in cases, more people are staying at home. Some of them are working from home, studying from home, staying at home almost 24 hours. Sometimes, so you spend more time looking at your furniture. You think that, oh, I need to have some upgrade, and that's what caused the increase in the furniture imports in the US, even though there was a rise in COVID cases. So on the Vietnam and Malaysia side, yes, due to the fact that the cases have been rising, on the Malaysia side, they temporarily paused the operations quite early on, I think in June, when they had the MCO 3.0, and Vietnam was closed more recently on 13th of July. But if we were to compare, the manufacturing facility in Vietnam is comparatively much larger, and the fact that on the Vietnam side, the government is taking a more discernible approach, such that so for Koda, they have already submitted the documents to the authorities for approval so that they can resume their operations, as long as they are able to let all their workers stay within this manufacturing plant 24/7. So they aren't allowed per se to, like go out and travel out of the area. Yep. So Koda has to provide lodging, meals, so on and so forth. So we expect them. This not only affects them, it also affects all the furniture manufacturers in Vietnam. So as long as they receive the approval and can resume the operations, then it wouldn't be that much of an impact in the long term. And anyway, FY21 has already ended June 2021. So and our forecast for FY22 is a 5% revenue increase. So we don't think that is very demanding. Yep. And for the second question, what is the valuation and TP and positioning of Koda compared to its competitors? So again, if you were to refer to our report published on the 23rd of July, on the peers, they are trading at market weighted, they are trading at about 24.7 times FY21 PE, FY21 EPE, while Koda is trading at 5.7 times. So it's quite a huge difference that shows that Koda is actually quite cheap in that sense. And if we were to compare to Manhwa, the biggest competitor, it's trading at 24.2 times FY21 EPE. So even though it's much larger and not exactly a direct comparable, but the difference is still quite striking. And if we were to talk about positioning, right, Koda positions themselves as a manufacturer of furniture that is more on the mid-range. So for their competitors, it's more of the mass products that you can get at cheaper prices. Yeah, so that's all for Koda. I hope that helps. And I will take on the next question on Fortress Minerals. So there's this attendee who asked about the outlook for Fortress Minerals. So we just had an update last week that, so it was the first Q FY22 results. So for Fortress Minerals, they are a commodity stock, so still very much dependent on the iron ore prices. And recently there have been articles of the iron ore prices coming down due to the fact that China is restricting the steel production. But on a fundamental point of view, you still need your steel products on a global basis, not only talking about China. You need them to basically build your buildings, your public transport, MRTs, and so on and so forth. So the demand will still be there, but the supply hasn't been keeping pace. That's why we increased our target price due to the fact that we increased the average selling price for FY22, pegging that to the $140 achieved in first Q of FY22. And the production projection is expected to increase 10% year on year for FY22E. And anyway, on the iron ore prices, right, it's actually still quite strong at still ranging about $200 per dry metric ton. Yeah. So and another thing for Fortress Minerals is that on the production side, they are still ramping up the production, or still preparing for commencement of production at Fortress Mangapur, which is their new mining concession, expected to begin by end of FY22. So it's around before mid of 2022, with the fact that iron ore prices are still quite high. Yeah, so the outlook is still quite positive. And yep, that's all for me for now. Hope that answers your question. Yeah, thank you.
Hi, I'll take some questions. Okay, at top of the list here is please comment on city development. So for city development, I'll just talk about a few things that have happened. I think in May, they announced that a bankruptcy filing has been filed against Sincere. So on the Sincere investment, actually the initial investment, including the JV investments, financial assets, the loans, that totaled about $1.8 billion on the Sincere balance sheet. On the CDL balance sheet, and to date, 1.7 billion have actually been already written off, impaired, and this impairment was taken on in December. So that was at the end of the financial year 2020. Okay, so currently, what is on their balance sheet total amounts to about 120 million, and most of them are in the loans granted, 109 million, and some financial assets, which are also the debt, US bond debt related. So those are 17 million and 109 million for a total exposure of 126 million. So significant portion, almost all of it has already been written off with regard to Sincere. So if we talk about some of the recent the recent release by the company, of course, I think the most recent one was the one where they said that they would be extending some help to their tenants, the retail tenants, and they remain supportive of the retail tenants. In terms of how they are doing operationally, so for those of us who are in Singapore here, we know that the property prices have been relatively robust. So that has led to quite a good sell-through for some of their development projects that have been launched this year. That includes Irwell Bank, which is near Great World City. Yes, the new MRT coming up there would be Great World MRT Station. Also, of course, they have some other projects that are also still selling. I think Sengkang Grand, which is a JV within CDL as well as CapitaLand. Yeah. So on that front, on the property development front, it looks relatively positive. Also, they are also selling quite a number of units in Australia, from the marker Melbourne, 80% pre-sold, and as well as Brickworks in Brisbane. Yeah. Okay, so for the remaining part of the business, we know that the retail is still quite challenged, still quite shaky, still susceptible to lockdowns or rather tightening of measures that may actually hinder the operational performance and may warrant some more help in terms of rental rebate and support for the tenants. Yeah, I think at the share price currently is still is I would say undemanding. $6.77. So that's about like 40% discount to the NAV. Yeah. Okay, so thank you for the question. I'll comment. I'll take the next question. Sorry, give me a minute. Okay. For Frasers Centrepoint Trust, how much of the tenants changed to F&B as new tenants mentioned were F&B? So their most recent tenant mix as of third quarter 2021 is 29. About 30% of them of tenants are in the F&B trade. So this compares to, of course, last year where it was about 29%. So for FCT, I think it has been relatively stable. 28 to 30% tenants in the F&B trade. They are not the highest amongst all the retail mall operators. Some even go higher, up to 30%, 35%. So of course, we know that within the mall, it cannot, the mall ecosystem cannot be all skewed 50%, 60% in F&B tenants. So I think the F&B component can increase, but I think there is a limit to how much it can increase. Yes. So for FCT, it's been relatively stable. Okay. Another question, why is CapitaLand reorganizing and restructuring so extensively? Was this long due intentional? Or are they trying to merge unprofitable units into profitable ones? Can you point out which CapitaLand listed entity we should track now? So I think this CapitaLand restructuring is part of their CapitaLand 3.0, where they are actually trying to grow more aggressively. And I think that if you recall earlier last year, they actually did a merger with Ascender Singbridge. So that was also quite a pivotal transaction. It allowed CapitaLand to buy over some industrial capabilities, from the Ascender's portfolio, and it also increased their exposure to new economy tenants, the likes of your business parks, your high spec assets. So that was of course positive for CapitaLand in terms of helping to rebalance its portfolio mix, which has always been relatively retail heavy. So with that, yeah, of course trying to gain, right now they're trying to get a better exposure or larger exposure to the new economy tenants and so on and so forth. I think the major thing driving this reorganization and restructuring would be that in the words of the management, they feel that the development business has been underappreciated by the markets, and that has translated into the development property developers actually trading anywhere between a 20 to 40% discount to their NAV. So because with this development business tagged to the CapitaLand name, people are always going to view CapitaLand as a development business, and when they do, and as such, right, they will always ascribe a discount to NAV. And because CapitaLand has been aggressively trying to grow the amount of fee-related income, which means the recurring kind of incomes, so they feel that they are not actually getting the better end of the deal. They can, by restructuring, decoupling this development business, which is a longer gestation, requires a bigger capital outlay and also a longer time for it to be monetized. Decoupling that from the fee-driven income, that would possibly, allow the new entity, which is called CLI, CapitaLand Investment, to be re-rated, and to trade at better valuations. So I think the decision behind this reorganization was very clear. It was to unlock value, and to help CapitaLand trade, or rather this CapitaLand entity that will now be privatized, trade at better valuations, instead of at a discount to NAV. Okay, so were they trying to merge any unprofitable units into a profitable one? The answer, I think, is no. Last year, of course, was a bit of a different year. Their PATMI was negative, of course, due to some of the impairment, and also not to mention the hospitality sector that I think was negative. Okay, and what CapitaLand listed entity should we track now? Currently, we are still looking at CapitaLand. What is going to happen is that there will be an EGM on the 10th of August, where shareholders will vote in favor or against this demerger exercise. So if that resolution passes and this restructuring goes through, CapitaLand will be delisted on the 17th of September tentatively, and the new entity CLI will be listed on the 17th of September as well. So on the 17th of September, that is when we can start to track this new entity called CLI. Okay. Sorry, just let me scroll on and see if there are any more questions for me. Okay. I think I may have missed, some of the questions may have disappeared from my list. I think I saw one about Dasin. So I think the question, if I recall correctly, was something along the lines of how do you justify accumulate call for Dasin? So currently at a share price of 52 cents, I think it is trading at significantly lower than where it was 2 months ago. Overall, this refinancing of the loan, or rather, extension of the loan to December, it does provide some reprieve for Dasin, allows them to crystallize the terms of their new loan refinancing. Okay, so all along they have been telling us that refinancing is underway. But I think what has actually held them back, in our view, is that the uncertainty between or rather the proposed transactions regarding the trustee manager. So the trustee manager actually currently is 100% owned by Mr. Chang. Of course, earlier in the year, in May, there was talks of 50% of the stake of the trustee manager being sold to ARA, which, as we know, is a global real estate management company, or rather, real estate player. And right now, a 70% stake could potentially be sold to Sino-Ocean. So I think this uncertainty in terms of the ownership of the trustee manager and the direction that could possibly change because of the change in shareholder ownership, that could have restarted the loan negotiation process.
So I think overall, operationally, in terms of, you see the recovery in China, the opening up of the economy, sustained opening up, I think all metrics point upwards. So as per the operational review that was done in the first quarter, Dasin was tracking our recovery, and everything was as per normal on the operational front, nothing out of the ordinary. The one that was really weighing down on Dasin was the uncertainty about the loan refinancing. With this new strategic partner, which is Sino-Ocean, as mentioned earlier, they have been a shareholder of Dasin since September of 2019, owning a 6.36% stake. So they already have sort of a significant ownership in Dasin, which when you take into consideration the 70% stake in the trustee manager, as well as the potential to increase their shareholdings to 60% of the trust, I think that really aligns Sino-Ocean with Dasin, and that could potentially mean that with this financially strong backer, it could open up the possibility for intercompany loans, etc. Intercompany loans, even extension of ROFRs, consolidation and synergies in terms of asset management. So we think that this is a little bit of a mild positive. Of course, we are not naive. We still look for key events such as the refinancing of the loan, as well as the refinancing of the loan, as well as, of course, the eventual exercising of this option that will then take Sino-Ocean stake to 26%. Yeah. So I think the message behind the accumulate call would be, we think that that there's still some hope for Dasin, and not to cut loss at this point. So you could choose to hold, you could choose to accumulate and average down, but we think that the game is not over, for Dasin. Okay, so I think that's all for me. I'll pass the time on to the rest of my colleagues first, and we'll see whether there's more questions for me. Thank you.
Yeah, I think there's a question on HRNet. So the question is, I think HRNet has issues with capital allocation, did not manage to use listing proceeds for M&A, and UK listed company acquisition did not work well. So let me just answer the question in two parts. I'll start off with the UK listed acquisition, which is Staffline. So just a background, Staffline is one of UK's leading recruitment and training providers. It has a market share of 10% in UK's blue collar recruitment and training. In UK's blue collar recruitment market, and has more than, I think, 60,000 of flexible staffing contractors that can be deployed daily. So from what we know, Staffline also owns the largest recruitment market share in Northern Ireland. And rightly pointed out, Staffline is still undergoing debt restructuring and is still in a recovery mode. So from what we know, HRNet still believes in the long-term outlook for Staffline. I think the key is how does that impact, the key question is how does that impact HRNet, right? So long-term investments like Staffline are actually booked under non-current financial assets at fair value in other comprehensive income, given that HRNet does not have any board seats or significant influence over the business that it invests in. So any gains or losses arising from the change in the fair value will be accumulated under investment reval reserves. Only upon disposal, then the cumulative gains or losses will be transferred to retained earnings. So from what I understand, HRNet is still keen on this long-term outlook for Staffline, and it does not have any it doesn't intend to divest any stake as of date. So in terms of capital allocation, HRNet has been expanding its presence in various cities, especially in 2018 and 2019, where it actually expanded in various cities. So even last year, when hiring was at a standstill, HRNet actually expanded in Jakarta and Shenzhen. And that said, right, cash levels for the company is still high at 250 to 330 million. So I think this actually highlights how HRNet is very cash generative. Even after paying 50% of its net profits in dividends, after M&As and expansions, HRNet is still able to keep that level of cash in the balance sheet. And from what we know, HRNet is still looking to grow in North Asian markets, especially in China, where the economy is still robust. So to wrap things up, we are still positive about HRNet's cash generative business, as well as the M&A growth that comes along for the company. Yeah, I think I see another question on land lease. So the question is, appreciate comments on land lease, target price with recent share price run up. So for LREIT, our latest update was released in May. We still have a cumulative call and a target price of 82 cents. In summary, we like that tenant sales for third quarter have recovered to almost pre-COVID levels at around 94%, even though footfall is almost 20% down below that of pre-COVID levels. We are expecting minimal impact from the code of conduct, and we also have the development of the Grange Road car park to look forward to. For the share price, we have not factored in their recent acquisition of greater stake in GEM, which was announced in June, as well as the impact of the recent extension of phase 2 heightened alert in our valuations. So this will be reflected in the full year update for LREIT and for LREIT, which will be sometime in August. This is all for my questions. I'll pass the time on to my colleagues.
Perhaps I'll start the next one. So yeah, I've seen quite a number of questions, so I'll be doing it. So yeah, first up, I think that the outlook for the banks remain corrective right now. You can see from DBS chart, there's a potential rising wedge. The area I plotted is really the potential trajectory of the bank movement. So any upside, right? I think you'll just be capped at the $31.33, the upper bound of the crucial resistance zone, and followed by a correction. So hence, right, that I'll be looking at the support zone at around $28 to $26.79, which is around support zone 1 for rebound. If you ask me, do you think it's likely to break up on the upside? Hard to say, but right now, momentum remains weak for now for the banks. So for the technical outlook for the banks, not very, I remain neutral for that. Next one is UOB and then followed by OCBC. Both banks exhibit the same kind of like reversal top pattern, which is a diamond pattern. And then it's right below the immediate resistance zone. Hence, I'm just remain neutral for UOB. First of all, I think the diamond pattern is not yet invalidated. So hence, I will just stay neutral for now. But you can see that the diamond pattern, the lower boundary of the support line, the trend line, has been tested multiple times. So hence, this is a signal of some sign of weakening. So hence, there might be a break below that. As for OCBC, I think it's still same scenario as UOB Bank. There's a potential evening star. So if this candle today closes as a strong bearish candle, a full body bearish candle, then we can find a confirmation, and then there will be a continuation of selling. We can see that backtrack a bit of few weeks back. That price has continuously like tested the lower bottom of the diamond pattern support trend, and then rebounded, but it just met with a lot of like a consolidation and sell down and buy it up again. So just remain neutral on this on the banks. All right, next I move on to Top Glove. So Top Glove initially I was quite positive that once it reached the support zone, it will rebound. But however, things are not really that going according to plan. First up, I think the rebound remain weak. Low volume remain low. You can see that despite a very strong spike up in volume on the 9th of July, it did exhibit a very strong momentum on the upside. So hence, I think all the glove company are taking a step back based on a technical chart. Hence, I won't put so much focus on the glove actually. So next one is SunPower. SunPower mentioned before, I think 2 webinars ago, that the dark cloud cover actually has threatened to push down prices already. So this pattern actually confirms the bull trap over here, and it fails to close above resistance zone, it gets down. So even it breaks the immediate support zone at at 0.72 to 0.765. Hence, the next one at 0.575 to 0.615 will be a very good support zone going forward. So I guess likely it's going to be this type of movement going ahead. All right. Hanwell is right now is consolidating. This potential double top still is still on the is still up, is still valid as has not broken the 0.395 neckline resistance. That doesn't mean that we are out of the wood yet. First up, we still need to break this resistance at 0.475 to 0.495. If you can retract a bit, this double top, especially this resistance zone over here, you can see that price on 15th on June, it actually has a very strong upside, and then it formed a shooting star, confirms the bearish sell down. All right, so this kind of phenomenon, usually we will say that there may be a potential selling lurking over here at 0.475 to 0.495. Therefore, it offers a very strong resistance thereafter. Next one will be Ping An. I think all the Hong Kong counters today exhibit a very strong sell down. Despite like on the mid of July last week, it rebounded, but price didn't really sustain through. And then price which I mentioned that this support zone is likely to break. And today with the gap down with a strong bearish candle, it's likely to continue the downside to the next support zone as 62 to 65.05. All right. Baba on the Hong Kong side is the same. I think 184.2 to 180 will be the best support zone to look at. All right, despite like on the 9th of July, it rebounded, but prices remain weak in the momentum to the break the upside. And furthermore, I mentioned that the 222 to 228 resistance zone need to be broken to further confirm the breaking of the falling wedge, and then thus start the new upside again. Okay. For Tencent is really a bearish candle. I mean bearish trend. The Ichimoku has already shown that the three bearish step loss has already been in formation since since the start of July, and then break of the major support zone at 517 to 539 further confirms it, and then it gaps below. So hence, I won't have much hope for Tencent for now, right now. Nanofilm has I think Nanofilm has really hit my target price as of today. First target price based on my report on 30th of June. I think it's likely to this wave ABC, this 1, 2, this third wave, right? Impulse start third wave is likely to confirm. So you will go according to plan as per my report says on the target price too. Yangzijiang a bit tricky. The support and resistance zone was rebounded last week. Okay, but the bearish candle today may offer like a new perspective. So price may enter into a sell down today if this bearish candle close bearish with what do you call bearish dark cloud cover. Jaffa has already broken the support zone 1. Likely we are seeing a major rebound happening at support zone 2. Price is continuing making a lower low and lower high. Frasers Centrepoint Trust, bullish upside is still maintaining. But the crucial support you need to really look at is 2.22 to 2.30. If this level is this zone at 2.22 to 2.3 is well supported, then there is a possibility that the wave E of the symmetrical triangle will rebound strongly on the upside. All right. Lastly, I think the Lion HST, the Hong Kong Singtech by Lion OCBC, the divergence didn't really play out that well. I thought that price may offer a very good rebound since there's a double divergence going on, but as usual, price already gapped down today and continue to sell down and then making a newer low. So hence, not really that positive on the Hang Seng Tech. Lastly, Beijing Airport, bearish pennant, bearish depth cross. So hence, not very strong on any upside. Furthermore, it's a very strong downtrend since the start of 2017. All right, so I think that will be all. I've answered some of the questions, but we have a webinar at 1 p.m. So I think any more questions we won't be able to take up. So apologies on that. Pass my time back to Paul and my colleague to do a final closure. Thank you.
Yeah. Okay. So sorry everyone, because we have the OTS at 1 p.m. Then we usually need like 10-15 minutes to do a technical sound check so that nobody complains during the event. So that's why we have to end it abruptly. But do remember, if you wish to post a question, you can just send it to our Stocks BNB community page and let's post a question and we'll try our best to answer it. So thanks everyone. Just a reminder, the next week it will start at 11:30 and yeah, because of some scheduling conflict. So thank you everybody for your attendance. Stay safe. The cases out there are really high. So stay safe everybody and have a good week ahead. Bye-bye. Thank you everybody.